Welcome to our deep dive into the secrets of the financial markets. Today, we'll uncover the key factors that drive these markets and how you can use this knowledge to your advantage. We're not talking about some get-rich-quick scheme, folks. This is about arming yourself with the information and strategies you need to navigate these wild markets. So buckle up, because we're about to embark on a thrilling ride through the heart of the financial jungle. Listen up, because this is crucial. Market sentiment is like the weather. It can change in an instant. One day it's sunny, the next it's a hurricane. You need to know what's driving those changes, what's making investors tick. Is it fear? Greed? A little bit of both? Think of it like a crowded room. If everyone's rushing for the exits, are you going to stand there and ask what's going on? No, you're going to run too. That's market sentiment in action. Now, how do you gauge this elusive beast? You need to be reading the tape, watching the news, and listening to what the experts are saying. But be careful. Not all experts are created equal. Some are just parrots, repeating what they hear. You want the ones with real insight, the ones who can see the forest for the trees. Remember, market sentiment is a powerful force. It can drive prices up to dizzying heights or send them crashing down to earth. Don't underestimate its importance. Understand it, track it, and use it to your advantage. Compounding is the eighth wonder of the world. It's like a snowball rolling down a hill, getting bigger and bigger as it goes. The longer it rolls, the more powerful it becomes. Think of it like this. You invest $100 today and earn a 10% return. You now have $110, but here's the kicker. The next year, you're not just earning 10% on your original $100, you're earning 10% on $110, and so on and so on. Over time, this snowball effect can lead to exponential growth in your portfolio. It's the closest thing to free money you'll ever get, but here's the catch. Compounding takes time. The longer you're invested, the more powerful the effect becomes. That's why it's so important to start investing early and stay invested for the long haul. Don't get scared off by market dips and dives. Those are just buying opportunities. Remember, time is your ally, not your enemy. Let the magic of compounding work its wonders on your portfolio. Everyone wants to buy low and sell high, right? Sounds easy enough, but let me tell you, timing the market is like trying to catch a falling knife. It's incredibly difficult and downright dangerous. Even the pros, the seasoned veterans of Wall Street, struggle to time the market consistently. So, what makes you think you can do it? Instead of trying to predict the unpredictable, focus on what you can control. Time in the market. The longer you're invested, the more likely you are to ride out those short-term fluctuations and come out ahead in the long run. Remember, it's a marathon, not a sprint. Don't get caught up in the day-to-day noise. Stay focused on your long-term goals and let time work its magic. You ever heard the saying, don't put all your eggs in one basket? Well, that's diversification in a nutshell. It's about spreading your risk across different asset classes, sectors, and geographies. Think of it like this. You wouldn't bet your entire life savings on a single horse race, would you? Of course not. You'd spread your bets around, just in case. The same principle applies to investing. By diversifying your portfolio, you're essentially hedging your bets. If one investment goes south, you've got others to pick up the slack. But diversification isn't just about mitigating risk. It's also about capturing opportunities across different areas of the market. Liquidity refers to how easily you can buy or sell an asset without affecting its price. Think of it like this. A stock with high liquidity is like a busy marketplace. Lots of buyers and sellers, easy to get in and out. A stock with low liquidity is like a deserted island, hard to find a buyer when you need one. Now, why is liquidity so important? Well, imagine you need to sell an investment quickly, but there are no buyers. You're stuck. And in a volatile market, that can be a recipe for disaster. Always consider the liquidity of an asset before investing, especially in volatile markets. You want to be able to get out quickly if you need to. Remember, cash is king, especially in a crisis. Leverage is like a turbocharger for your investments. It can amplify your gains, but it can also magnify your losses. Think of it like this. You're using borrowed money to increase your potential return. Now, leverage can be a powerful tool when used correctly. It can help you achieve your financial goals faster. but it's not for the faint of heart. If your investment goes against you, those losses are magnified. Here's the bottom line. Leverage is a risky business. Use it cautiously and ensure that you can cover potential losses. Don't let leverage turn into a nightmare scenario. Economic indicators are like the vital signs of the market. They give you a glimpse into the health of the economy and can help you anticipate future market movements. Think of it like this. If you're feeling under the weather, you might check your temperature or blood pressure to see what's going on. Economic indicators are like those vital signs for the market. There are tons of different economic indicators out there, but some of the most important ones include GDP, inflation, unemployment, and consumer confidence. Understanding how these indicators affect the markets can help you make more informed investment decisions. It's like having a crystal ball, giving you a glimpse into the future of the market. Listen up, because this is crucial. Investing is as much about psychology as it is about numbers. Our emotions can often lead us to make irrational decisions, especially when it comes to money. Think about it. Have you ever bought a stock on a whim, only to see it crash and burn? Or sold in a panic, only to watch it skyrocket afterwards? We've all been there. Behavioral finance helps us understand why we make these irrational decisions and how to avoid them. It's about recognizing our biases and developing strategies to overcome them. Remember, successful investing is about staying disciplined, sticking to your plan and not letting your emotions get the best of you. Master your emotions, and you'll be one step ahead of the game. Thanks for joining us on this journey through the financial markets. Remember, successful investing is not about timing the market, but about understanding it and remaining patient. We've covered a lot of ground today, from the importance of market sentiment to the power of compounding, from the dangers of leverage to the insights of behavioral finance. Now it's time to take this knowledge and put it into action. Stay informed, stay disciplined, and never stop learning. The financial markets are constantly evolving, and so should you. Happy investing.